Corporate finance practice problem using OneNote. Preferred stock, borrow, and invest decision. Get ready. It's time to take our chance with corporate finance. Here we are in OneNote. If you have access to OneNote and would like to follow along, you're not required to, but if would like to, we're in the icon on the left-hand side in the Practice Problems tab, then down in the 1731 Preferred Stock, Borrow, and Invest Decision tab. Also note, when using OneNote, look at the immersive reader. Our presentations will be down in the text area as well, same name, same number, but with transcripts that can be translated into multiple different languages and either listened to or read in them. Closing the icon, we have our information up top. We're going to go through the calculations then on down below. We're looking at the preferred stock again, this time from the investor side of things. So we're thinking about investing in preferred stock, and we're thinking about taking out a loan in order to do so. So the general scenario being preferred stock investment, we're thinking about investing the $350,000, having a yield of 11%, and we're thinking about borrowing to invest the entire amount of the $350,000. Interest rate to borrow is 13%. Now, on the face of this doesn't look like a good decision given the fact that the return that we're getting is only 11% as compared to the rate we're paying on the borrowing of the funds, 13%. But when we take into consideration taxes, there could be a difference, and that's what we're going to basically look into emphasizing at this point. So this isn't the tax code can clearly change, and where individual corporations are and their tax brackets could change, and the law could change from year to year. This is a general idea of what could happen with the tax brackets. Of course, you have to take into consideration where the current tax brackets are at any given time. So we're going to say that the tax bracket for the ordinary income is at the 30%. We're going to imagine we're at the last tax bracket at that point, or at the margin at the point we're making the decision now, or at our highest tax bracket being the 30%, remembering that we are in a progressive tax system with regard to the ordinary income generally. But when we make the decision, it's on the margin. It's the last thing we are doing, and therefore we typically would make it with the last tax bracket in mind. So we have the dividends at 10%. So the tax bracket for the dividends is going to be lower, and that could be often the case in the law. They might try to emphasize investments in things like corporations or equity type investments, and they might have a lower dividend tax. And we're going to say that a percent of the dividends that are tax exempt. So we actually have a tax exempt portion of 70%, and then the tax rate at a dividends rate of the 10% as opposed to the ordinary income of the 30%. Whereas when we think about the borrowing of the money, because it's a borrowing and we're thinking of it in a business situation, assuming we get the expense as a deduction, we're going to get a tax benefit on the borrowing then at the ordinary income, or the ordinary income tax bracket at the 30%. Okay, so let's go through this. Let's see if that difference in the taxes are going to make up for this difference in the return being the 11%, and then the cost or the expense related to the borrowing of the money at the 13%. So first, let's think about the after-tax return and yield. So we're going to say the investment in preferred stock is going to be that $350,000. I'm going to pull in the trusty calculator here. Trusty calculator is in business. Then we're going to say that the yield is 11%. So 11% is going to be our return. That means we're going to get $350,000 times the 0.11, 11%, or the $38,500 as our return, $38,500 before the taxes. Then we're going to say that there's an exempt portion of the 70%. So 70% of it is not taxed. So let's calculate the portion that is not taxed. I'm going to say the 38.5 times the 0.7. We're going to say 26,950 not taxed. And that means the taxable amount, we can calculate this minus the return we're going to get, which is the 38500. That's going to be the 11,550. Now note, you can kind of get there a little bit quicker, and if you're looking at like a book problem type of answer, they'll probably do it this way because it's a little bit faster, although I don't think it gives you quite as much information than calculating the entire thing out. But you could take then 1 minus the 0.7, that's going to be the amount that would be taxable, times the 38,500 or return, getting to that 11,550 taxable amount. Then we have the tax rate there, which is the 10%, the lower of the rates, because we're at the rates for the dividends as opposed to the ordinary income. We'll take that 11550, multiply it times 0.1, and we're going to get the 1,155. That's going to be the tax. Then the after tax return, we're going to say is going to be the return before taxes was the 38.5 all the way up here. And then we've got the tax, which is only the 1155. So let's say let's take this minus the 38500, and that's going to give us our 37,345. So 37,345 is going to be then the return. And if I compare that to the original investment, then we're going to say, okay, we got 37,345 divided by the original investment of 350,000. That's going to be, if I move the decimal 2 places, over 10.67%. So 10.67% return after tax or after tax yield. Let's think about then the loan. So on the loan, we're going to have to pay interest, but we're going to get a tax benefit from the interest, and we're going to get that at the ordinary income tax rates, or the 30%. So we're going to say, all right, let's do that. We got the borrowing of the $350,000. We're going to have to pay 13% on that, 350,000 times 0.13. That's going to give us the 45,500. And then the tax rate on that is 30%. Now we're going to get a tax benefit this time. So times 0.3 gives us a tax benefit of the 13,650 on the tax benefit. And therefore, we take that minus the interest, which is 45500, and that's going to give us then the 31,850, the after-tax borrowing costs. So again, we're paying 45,500, but now we're basically saying that we're going to get back from the tax benefit the 30% of it at the 13,650. So we have the cost that's really going to be the 31,850. We could also calculate that this way, and this is a way you might see it in a book problem because it'd be a slightly faster, although I don't think as intuitive when you're doing the calculation. You can take 1 minus the 0.3, that's going to be the 0.7, and multiply that times the 45500. That's going to give you the 31,850 again. So then we can compare that 31,850 divided by the original amount borrowed, which is going to be the 350,000, and that's going to be the 9.1%. So you can you can see here, if we take a difference between the two, we got a return of the 37,345 minus the 31,850. That means we have a 5,495 benefit from the investment, even though we have an investment that's yielding less than the amount that we're paying for the borrowing, and we're borrowing the entire amount to invest, and that's all due to the difference between the tax rates down here. So the tax rates with regards to the investment on the dividends and the deduction with relation to the interest expense. So that's just to show, now tax laws can change over time and so on, but that's just to show obviously that tax has a significant impact when you're thinking about the investment decisions. Now you might say, well, okay, at what point, if the borrowing rate keeps going up, this rate we had here at the 13%, how high could that go, keeping the yield the same, to get to our break-even point, meaning these two things are the same? That could be one question we might ask, and this could be something that obviously we might want to run scenarios to see, well, what would happen in the future if there were changes to the borrowing rate, for example, or changes, say, to the tax law or something like that. Then we could run scenarios such as this. So I'm going to go back down. I'm going to change this number here. We're looking for this interest rate to be the rate at which these two numbers would be the same. Now, I would run this in something like Excel, where you could use a goal seek type of feature. And the goal seek would look something like this. You could do this basically manually as well. If this whole thing was tied together, meaning all this information is based on the data up top, that's kind of our model that we have here, then you could change this cell. You could start to say, okay, what would happen if I changed the 13% and made it to 14% or 15%? And if everything is tied together in Excel, which we will do, and if you want to work in Excel and put this together, you can do so, but just from a conceptual standpoint, that's what we can basically start to do. And then we can ask Excel using a tool called GoalSeek to basically say to Excel, would you please make this, let's say this cell right here, which is going to be this minus this, equal to 0. We would like you to do that by changing this percentage in the data group, which will change this percentage here for the interest rate. If we were to do that, then we'd get something like this, where we have then the rate changing to the 15.24. So, and it's rounded to 15 over here. So at that 15%, then we end up at this break-even point where we have the amount of the investment at the 37,345 and the after-tax borrowing cost of the 37,345. And that's just to show that if you set this stuff up properly in, say, an Excel table and take the information from your data up top, then you can, of course, run scenarios into the future and make some what-if, you can do your what-if type of analysis, and using the tools such as GoalSeek to just basically equivalate or see where your break-evens would be is often a place to start when you do that type of analysis.